Well, g'day everyone. It's Liam Garman here, Managing Editor of Real Estate at Momentum Media, the team that brings you the Smart Property Investment Show. And welcome to our first webcast of 2025, where we're going to be unpacking property investing for first-time investors, an incredibly important topic as people navigate their property investing journey. And join with me today is an amazing group of experts who will give you the tips and tricks that you need to start your property investing journey. And I'm joined by Arjun Paliwal, founder and CEO of InvestorKit, Eva Loisance, head broker at Finny, and Manzarul Khan, chairman and founding partner accounting at KHI Partners. And thank you all for joining me today because it's a very important topic that a lot of Australians are looking into. And for good reason too. We've got a bumper year, a bumper 12 months ahead of us in the world of property investing, but also I think it's reasonable to say that there's a whole generation of young Australians out there that might be in major cities that are unable to buy a PPOR. They're not looking to do the traditional route of having an owner-occupier first and might be looking to going on a rent vesting journey. Now, you each bring three very distinct, very unique skill sets to the table, which is why the four of us have come here together today to give people those tips and tricks for their property investing journey. And I think we should go through a lightning round, introducing ourselves and your investing journey and what you do day to day. Manzarul, would you like to kick us off? A 30-second intro on who you are and how you can support property investors.
Yeah, absolutely. Manzarul Khan is my name. KHI Partners is what we look through. We're a multidisciplinary service, accounting, financial planning, mortgage broking, bookkeeping, and a whole bunch of things that we do. We're very property-oriented accountants, being around for a number of years, personally an investor as well, and very passionate investor.
And jumping across to Arjun.
Yeah, my name's Arjun. I'm the CEO and founder of InvestorKit Buyers Agency, predominantly helping property investors getting data-driven insights to scale their property portfolios across Australia. And we've helped over 2,000 purchases and over $1 billion in experience to make sure people are getting ahead with the right data and right insights.
Eva?
Hi, so I'm the head broker of Finny, strategic mortgage broking investor myself, and I just like to think of myself as someone that would help strategically people to get onto the property ladder and build a portfolio.
Now, it's fantastic that we've got all these different skill sets here today because just before we hit record, I think I've learned something from each of you, which it sounds a bit funny to learn something so quickly. But even Manzarul, when you and I were talking before the webcast started, and you were listing off, you're firing off a bunch of different things that are tax deductible, which a lot of first time investors wouldn't necessarily know. Arjun, for yourself, that data-driven analytics, a lot of investors might fall into the trap of going into too much of a blue chip property, capping themselves off at that one property because it's so negatively geared that they've got no real ability to scale their portfolio, which is a perfect example of why first-time investors should be partnering with experts like yourself to make sure that they've got a long-term strategy, they've got a philosophy that's guiding their investment decisions, and not really just throwing a dart at a dartboard and buying a place that lands. And for yourself, Eva, I've seen throughout my career so many mortgage brokers that don't actually have skin in the game and they don't understand the world of broking truly because they're reading numbers off a screen and they're not necessarily appreciating how they are an integral part of taking people on their journey. I always think the best place to start, and I'm often reflective with this, when I'm talking to first-time investors or first-time home buyers, I always think the best place to start is perhaps looking at some of the do's and don'ts, some of the mistakes that people have made on their journey as that springboard. Arjun, what are some common mistakes that first-time investors make that you've seen quite often in your career?
Yeah, so I'd say the few mistakes that come off often is that once they get a budget and they usually get excited as a couple that the budget is bigger than what they thought because it's now two incomes, two people coming together. And they go, wow, well, I want to squeeze the best I can and use that budget the most I can. And what ends up happening is they look at area first, then property. So if you go area, usually things like distance to CBD, beaches, shopping, schools, these priority factors from an emotional sense lead the way. And when they lead the way, now you go to price and you're like a disconnect between the price of what you thought you can get versus what the actual market's showing. And so then the part goes, well, I've got a quick fix to this. asset type. And they usually find the unit in that market to now tick that box, and it gets them in that best area in their mind. So it's emotional setting on the logic of the area. Then it's logical setting on the price of the property that fits that area. So it's a unit decision. And now you put emotion and logic together. It doesn't always equal the best decision, because as we've seen over the last few decades, certain unit markets across Sydney, for example, have been very big underperformers. And there are parts of Melbourne that hasn't even grown for over a decade in terms of the same price over 10 years ago to today. So this is very common, and it's unfortunately the biggest mistake in my eyes that investors make first time. They get rosy with the budget, they find the best area, still is not good enough for their budget, and then they reverse that usage of the area to the property, and they end up buying the most entry-level property in that area, and it's something that doesn't really hold well long-term for capital growth. So emotion and logic don't have a place together when you're trying to build wealth and use investing as a vehicle to do so. You've got to create some separation.
And you see that quite often. I know there are a lot of ex-Twitter profiles that actually track the sales over time, and there are a lot of places, especially in the larger capitals, where you're seeing that 10 years of no growth. In particular, one suburb that comes to mind for me is Parramatta, where you have had such an oversupply of units come on board that you've got units bought in 2015 that haven't appreciated in value really at all, and in some cases have actually dipped in value. For people that maybe some of our listeners have started their property journey. Maybe some of our listeners have bought one or two properties. They're in a bit of a rut. They're looking to scale, or perhaps they've actually fallen into that trap. How can they get out of it? Or what advice could you offer to them if they're thinking, okay, I've sat in this asset class. I've owned it for 10 years. It doesn't look like it's going to get any better. I look out the window and there's more and more and more supply coming on market. What tips and tricks could you offer them?
Yeah, so I think the first one is the hardest one. You can cut your losses, and you can often redistribute that money to other places. And if you just use the last 5 or 6 years of what people have done when they've redistributed money in the right places, you've seen some property markets perform really, really well. And so people sometimes feel like because it's gone wrong for so long, I can't trust myself to make that next decision to be right. So let me just fingers crossed and stick through this one. And so they cause themselves even more pain. When you can cut certain losses and move on, that's another part. Now, the next part to mention as a tip as well is that people should assess their numbers with multiple options of banks. And this is where, some of the others will speak about that. But the main point of looking at that is you may think one bank has made it a maximum decision of your capacity, but other options exist. And as soon as you explore that other option, you can go, well, I might keep this one. Maybe it's not cutting my losses just yet. And I might look at redeploying capital better the next time around with someone else. So those are probably the first two quickest moving factors of cutting losses or find better places for the next capital and just learn from previous mistakes. But another one to really point out as well is that if you've made that decision, it's important to go and say, well, it's likely the most common thing was you trying to buy a place to live in, trying to tick emotional boxes, and you've become now an accidental investor. And you look at this and you move out, or you haven't moved out, you may be willing to move out, whether it's an upgrade, a family change in a dynamic, and you go to a house. And so I asked yourself, well, before you move out, now you don't look at this home as, oh, we bought this, it was our first place. Just treat it as an investment property. How do you feel about that decision? Well, it's got lots of supply, it hasn't grown as well, I don't see it being fast and easy to find a tenant and rent out, so it hasn't performed well. So now because you've got this investor mindset on, your scorecarding things a little bit differently, and just that wake-up call there to realize that can help with that first and second decision of either cutting the losses or trying to make a better decision the second time around. So evaluation, then the decision of cutting it, or moving on, but just with a better decision the second time around.
There's a very big element of human psychology that goes into that, because people do have a hesitancy to cut losses, but also to get rid of their first home where they've made memories, they've had children or whatever. But if you do want to make money, you do have to look at it on a pure numbers basis. And if your money can work for you better elsewhere, then that is an option that you should be looking at. Now, Eva, one thing that I think stumps a lot of first home buyers and stumps a lot of first time investors is the true cost of investing and buying a property. And I think just in discussions with a lot of people, one thing that a lot of people do get stuck on in terms of a hurdle is you do the quick maths of, okay, so this is a $600,000 property. If I put down 10%, then I need to save $60,000. But they fail to add up things like LMI, conveyancing fees, etc. Could you give us a breakdown in how much it really costs to buy a house, what kind of capital people should be saving up, and any of those hidden costs that they incur along the way that you see as a broker?
Yeah, so there's a big misconception there. And you say, how much should you save? How much should you have? Really, there are ways to get in with nothing. There are ways. There's guarantors loan, there's family pledge. You actually need as little as 5%. Really, there are still lenders doing that. So I think there's a huge cost and opportunity that is lost for people just to wait until they have 20%, which is for most people a lot of money, right? So ideally, as an investor, you would want to have 10%, but then that's 10% plus stamp duty, plus legal cost, plus financial planning if you need that, plus a bit of buffer. You know, when you buy an investment property, there might be some maintenance and repairs costs that are needed right away before you can have a tenant in there, and to maximize the rent you might be able to get. But really what people should get out of that is you can start with very little, very, very little, if anything at all. And the family pledge option is very underused and known. And really with that, you can borrow the property price plus the stamp duty plus legal costs plus everything. So you don't need anything.
So can you talk to us through that and how that works?
So that is basically a way to use your family property as a collateral. And you use the equity in that property to buy your investment property.
And that extends to investment properties as well.
Yeah.
So a tangible case study of that might look like your parents' home. Your parents are willing to put up their home as collateral.
Yes, it can be their home, but also could be your parents' investment property. And the great thing with that is your parents don't need to give you hard cash. So it doesn't cost them anything. It's only temporary. You know, after a few years, their property is released. So really, it's a great way for the parents to help the kids and the kids to get into the property market quicker without having to save so much money.
Is that something that would seem, I think, to a lot of people to almost be too good to be true? What do the numbers look like afterwards? So you've signed the guarantor loan, the house has been put up for collateral. What is the discrepancy in, say, the monthly repayments, the negative gearing of the house? Because that might perhaps direct the decision.
It does that up. So obviously, if you don't have your, let's say, 20% plus cost as hard cash, obviously that's when you are borrowing. So obviously your monthly repayment would be higher. If it's an investment property, though, Monzo will confirm it would be tax deductible. So yes, the property might be a bit more in the negative side of things, but at least you are on the property ladder. And with a good buyer's agent, you could find a property that, you know, has good rental yield to compensate for that.
Absolutely. And thank you for bringing up the tax, because I think this is something that it's a really hot topic at the moment. The tax aspect, of course, we're going into what a lot of people are considering a property election soon, and we've had negative gearing tax really in the spotlight for years now. But it is a mystery for a lot of first-time investors, and something that people might have read about in the news but don't necessarily have an in-depth understanding. Mansoor, to kick us off, can you give a bit of a 101 explainer of what negative gearing is and how it can help our first-time home buyers?
Beautiful. The negative gearing is where your deductions on an investment properties are higher than your rental income. So let's utilize that example that Eva was giving. Let's say that $600,000 property that we're buying it, right? So Eva is sort of saying is that, all right, we get a family pledge and we get a guarantee, we get a family pledge. We're effectively borrowing that entire $600,000, and let's add away all the incidental cost. So assuming that there is no LMI because we're borrowing is still 80% and 20% coming in as a pledge. And LMI is that when you borrow over 80% as such, right? So we've got 105% is our leverage. And the reason why we say 105% as a basic rule of thumb, what the property investors should take into account is to say it takes 5% on top of the purchase price, give or take, for a stamp duty, solicitor's expense, bits and pieces of other things, excluding the LMI, which if it needed, we can very well capitalize it as such, right? So give us example, let's say $600,000 property, we're buying it, we add away 5%. So our loan on that example is $630,000. Yeah. So what we do is that we do two sides of the equation. We start with the income side of it, saying that, well, $600,000 property, how much would be the rent? If it's a 5% yield, we get roughly about $600. So let's assume about $550 or so, give or take, where the New South Wales is at the moment, right? So you say $550 is the rent, you multiply that by 52, that becomes your overall annualized rent.
Do not ask me to do that on the spot, please.
I was trying to do it on my mind, and I was like, I like my calculator. So you multiply that over 552, right? So that's your overall rent. You take away the expenses, so you've got an agent's cost, yeah? And then you sort of say, all right, okay, there could be a whole lot of other council rate, water rate, you know. If it's a unit, we've got a strata expenses that we need to pay. Of course, there are insurances that we need to pay. And you can't assume that it's a 52 weeks. You take away a couple of weeks, say that it's rented about 50 weeks, being conservative. So you get a net rent. So it's not your gross rent is what you receive. That's probably his really first fundamental point, right? That you sort of go back into a level of conservatism, still a level of practicality to say that's your net rent. Then you go back to the EVAS exercise saying, well, I'm borrowing $630,000. What's my interest cost against that $630,000? And let's assume that the interest is anywhere between 6.5%, let's say, as at now. So we take that interest. So how much is my interest cost? So let's assume on this side, I'm getting about 23 grand as my net rent, 22. And in this side, let's say assume that we get about 33 grand, and numbers are not exact, right? So we get 33. So my rental net income is 23. My interest is 33. That means I'm out of pocket by 10. So 10,000 is my out of pocket, which is the negative gearing. That's the negative gearing. So how it works from a tax side of it is that 10,000 becomes a net deduction on your tax return, and you get a tax back, right? You get a tax back on the basis of your marginal rate. So it goes all the way to 47%, and it can come down to early 30s. So if you sort of say I'm getting about 32, 35% out of that 10 grand that it's actually costing you, is I'm getting about 3.5 grand from ATO as a tax refund, and then net is about 6.5 what it cost. So my negative gearing is 10, and my deduction after the tax benefit is about 6.5.
Now, a lot of investors have been scared out because of terms like tax, especially in more affordable markets, say in the Melbourne market. Or the Victorian market, where it is more affordable, but a lot of investors do get a little bit nervous, rightly or wrongly. Can you explain the phenomenon of land tax and how that works and how it's calculated and how this ties into the overall equation?
Beautiful. If I might take that question into two different elements, right? One is the factual question in terms of what are the land tax and how it is and where it is. And the second part of it, which was the first part of the question, is that the psychology of the humanity, right? We're a little bit scared about the Melbourne market at the moment, right? Because government is imposing all those different tax. The point is valid, right? But if you look back, if you extend your reference point, so to speak, for a very longer period of time, it's that invisible hand of the economics, as we call, the Murphy's Law of average, as we call, is that everything gets balanced out over a period of time. As soon as you see an anomaly on a particular market, is that in one shape or form, the investors will see that anomaly as an opportunity.
Yeah.
That's right. They will see that as an opportunity, right? And they sort of go into that opportunity and it gets balanced out, right? And that's where the buyers agencies are, is to see where the opportunities are. So you're right. I mean, the land tax side of it at the moment is not right. It's not right in the sense that if I compare the land tax, let's say New South Wales, is that you've got $1,035,000 as a threshold and you only pay land tax subsequent to it, right? If we look into Queensland as an example, you get about $600,000 as a threshold. These are all as an individual. If you buy it as individual, if you buy it on trust, it's a bit different, yeah? So as an individual, if you're buying it $1,035,000 or so in New South Wales, Queensland, you get about 600 odd grand, right? But in Western Australia, as an example, you get about 300 odd thousand, right? But as soon as you go to Victoria, they start charging you land tax from as low as 50 odd grand. Mind you, the percentage is low, right? But you look into that land tax and you say, bugger. You know, I mean, the land value sort of increases over a period of time. So whatever the land tax I'm paying, number one, it's an annual tax. I'll pay that forever. And number two is that I'll pay that progressively more and more and more. So it is a bugger. There's no question, right? I mean, the commissioner tried to justify saying that, well, It's a tax-deductible tax, i.e. I can claim that as a tax deduction. Does it take away the bargain? I'll prefer not to pay it in the first place.
So what numbers are we talking?
Yeah, about 50-odd grand. And over 50-odd grand, it's about 0.3%. And then it sort of increases a bit higher as such, right? For a first-time buyers, is that for 600-odd grand, is that you quite easily paying about 6-7 grand land tax.
Okay. Now, I do appreciate what you were saying about the arbitrage aspect, and it's something that I think we can all agree on. We've seen over recent years that a lot of the growth in areas has been clustered in that lower quartile, that second lower quartile, rather than, say, very expensive houses in Sydney, where you're just simply not getting the yield, and your money is working better for you in regional areas or outer urban areas or some of the smaller capitals. I think we were talking just before the webcast started that you two, Eva, Mansoor, were talking about investing in Melbourne. Is that, you're comfortable with it? You're happy with investing in Melbourne? Or have I stepped over the mark? Are we not talking locations?
Look, I personally bought a few properties in Melbourne last year, and I've been investing for many years now, 25 years, 26 years. And then when I see, Arjun, some of the statistics saying that, okay, Sydney has always been the priciest, right? Of course, we get that, right? Then we sort of say, well, historically, whether it was Melbourne, whether it was Brisbane, there were a couple of times Brisbane was higher than Melbourne. So we get that as well, right? But now we sort of say, okay, so we've got Sydney, you've got Brisbane, then you've got Perth, and Adelaide is sort of saying, hang on, we're not that small, we're still around, right? And Victoria is sort of going all the way back in there. There is a logic to it, of course it is because of all those government tax that they're sort of imposing, they're sort of taking away the investors. And if you look through the budget of the state government, it's quite in deficiency. So there's a whole lot of a structural as well as the operational reason, right? But at the end, I cannot go beyond the fact that it is still a metropolitan city. It's probably one of the largest, sort of Sydney, Melbourne, and then Brisbane. This is where the immigrants come in. And over a period of time, whether we see that as an opportunity as opposed to a risk.
Now, I understand that, Arjun, you keep your postcodes like a closely guarded nuclear secret, because I know it's important for your business that you don't share out the postcodes.
Well, funnily enough, it's actually quite the opposite for us.
Oh, so you are happy to talk?
No, as in like you would have noticed over the last sort of 7 years in Australia, we've shared the most public research available to Australians. With the most downloaded research papers in Australia, the most mainstream features in Australia amongst any property commentator outside of a data provider like CoreLogic, with over 220 features a year, talking locations, talking markets. So it's something that we do regularly more than anyone. So I might touch on a couple of things Mansoor said on the land taxes and things, because it's really important to note that. I have a logic on this where I look at it from 2 points. First is I think that the case that I think is the worst in one location, I assume everyone can follow. If you go in with that mentality, because remember, we're not talking about a person or a company doing this, we're talking about a state government. And so don't think that just because like there's a better state government or a worse state government that, they will forever be better or forever be worse. I think the things change, and once someone goes, if you can get away with it, I will too, right? So I would assume that the whole world for real estate is going to move towards moves that make more taxes in terms of the everyday investor. And so if you've got this mindset logged in that that's the case and Melbourne's just moving one step further or faster, your perception and the emotional part of how that impacts you starts to shift, right? Then you put that aside and you treat it as a business decision, being the ins and outs of a property. You realize that everything in history has always been self-regulating, right? And so self-regulation in this form, when you have more expenses on you, is usually going to be how many investors sit there versus how many investors depart. And there becomes flow-on impacts of this. We've seen as investors depart, we've tracked rental bond data quite closely, and more rental bonds have been departing Victoria than ever before at a very fast pace. That reduces overall rental supply. And as we know, with the mass immigration, rents and rental properties are the areas that are seeing the most demand from migrants coming in, because studies by the Grattan Institute in the past have suggested that migrants, on average, rent for about 4.5 years before they transition to buying decisions. So if we see a return to the population, if we see rental supply dwindling, and if we see more and more costs and things like that, they'll start being balanced out by rental growth, right? Now, rental growth, surprisingly to many, even though house price growth in Victoria hasn't been as good, rental growth has been phenomenal in the last couple of years. And so this moves a dynamic called rental yield, which is your rent times 52 divided by purchase price expressed as a percentage. So if you keep seeing rental yield rising, it does two things psychologically. First, investors see value because I'm now seeing this much rent in comparison to purchase price, and I'm not used to this in Melbourne. Yes, a portion of it's lost because of added expenses, but as this number keeps riding the way up, investors keep looking at this and going, this is Brisbane rents and rental yields, but for Melbourne housing. Now, they don't represent the majority. In Australia, 65% of homes are still owner-occupied, so they don't represent the majority, but there's still a wave of transactions. Then you have the second group, the group of renters. And renters don't magically wake up with capability on every household to be able to buy, but as time goes on, renters have capability-driven decisions, and then they have emotion-driven decisions. And if you talk to most people who transition from renting to buying, all of them will have capability as a goal or a desire at some stage, but then the actual emotion kicks in out of frustration commonly. My, property owner or landlord or the person I'm staying this property at increased my rents 3 times in the last 2 or 3 years. It's shocking. They jumped it up this much. They don't know the cost. This is crazy how it's gone from here to here. And every time you have a frustration, you either just complain about the frustration and do nothing, or you seek to do something. And if every time you seek to do something and over the last 7 years, the prices of a given city haven't been moving, then you're seeking something and it's not getting more expensive for you, but wages have been increasing. Now you're looking around and choice is increasing because supply in that city in comparison to a 5-year average is still not very low. So choice, capability, lending capacity is going to start improving as well as rates cut. And then the emotion piece, the frustration pointed against you because every time an increase in rent but no corresponding increase in price, your desire picks up. So now, again, this is not the majority because it's 2 subsets, a renter subset and an investor subset. But then they drive transaction shifts and behavior changes. And as the old saying, monkey see, monkey do, owner-occupiers may start looking at this and start going, hey, is this something shifting? Do we look at our plans of upsizing, downsizing? So whilst this isn't structural guidance of what a city's doing when it comes to economy, supply data, listing data, and actual all the data sets, these are the emotional sides that people actually don't consider, which all packages to sentiment shifts. Right? So I think in that logic part, yes, the taxes are there. The structure still isn't as sound as markets, say Adelaide, where supply levels are 30 to 40% below, 5-year averages, and month-on-month growth rates are still very, very strong in many parts of Adelaide. Great. That's the structural strength. But it's clear the sentimental strength is really starting to shift in Victoria. And as time goes on, the structure will follow when things all come to tick boxes, whether it be infrastructure, total housing supply, building approvals balancing out. So it's just a matter of when, but we can see the sentiment sides definitely coming up. Just to talk further on the land tax part, but also to answer your question on Melbourne.
I think, Arjun, if I may make this point, is that everything which you say, I agree, right? It sort of comes back to what is the reference point of an investor. Are we looking at short term over the next 1 or 2 years? Are we looking at the longer term? And I think that's probably one of the very first thing which I'll start with an investor side of it, right? Is to set up your longer term vision. So you asked that question to Arjun that, what are the areas and tips and traps for a first time investor? Very often when we get someone, a first time investor coming in, before we go into anything, where to buy, how to get the finance, how to do the structure, I say set aside all of those. Let's go through a deep dive in terms of what is your goal in the longer period of time. Let's do that to SMART goals. Let's dream ourselves, visualize ourselves where we would like to see in 15 years' time, bring it back to 10 years' time, bring it back to 5 years' time, and then bring it back to 3 and 1 year time as such, right? 15 years' time could be as sort of, I suppose, blue sky, and then we come back to 10 and we come back to 5, right? And very important of going through that exploratory session is to say, where are you at the moment in terms of your assets and liabilities and income and expense, where you would like to be in the longer period of time, and then see everything else in terms of location that all comes back in. The challenge with the property side of it we hear at times is that do we have diversification? Well, if we buy all properties in Melbourne or if we buy all properties in Sydney or all property in Brisbane, we don't have diversification, right? But ideally, in the longer period of time, that first-time investor should plan is to say, okay, whether I buy to Melbourne or not, my next property, in the longer period of time, I want to say Melbourne part of my portfolio. I want to seed that part of my portfolio. I want to seed that part of my portfolio because the cycle goes around over a period of time, right? And when you have that longer feature as such, then you sort of take away some of the noises of the short term, the land tax, the short term, the government, short term, the anomalies, because in the longer term, it balances out.
Absolutely. And I think that the goal setting is incredibly important to reverse engineer the steps that you take on the process. And there are going to be people listening to this webcast that would be looking at property investing as a mechanism to buy their owner-occupier in Sydney. That's their goal, right or wrong. That's what they're looking to achieve. You're going to have people that are looking to this to build passive income. There's going to be people there for the wealth accumulation aspect. But that's the reason you goal set, because the steps on the way to that process are going to be unique and very different. Arjun, you mentioned a word before, which I think we need to really, really, really dig down on, and that's yield. Because this is at the crux of the financial reasoning, I think, behind rent vesting. It's a very reasonable way of saying it because, you know, we have so many people that come on the SPI show, a lot of our guests that might have property portfolios, dozens and dozens and dozens big, and they're still rent vesting. Why? Because the yield on their money is better in their investment properties than the money that they would have paying down their owner-occupier. For a lot of Australians, it's almost an inversion on the traditional white picket fence mentality of I'm going to save up, I'm going to buy my owner-occupier, and maybe down the line a few years I'll buy my investment property. So it's a bit of a reverse thought on that. Can you take us through the concept of yield, why it's important in property investing, and of course that leads on to Eva before, because that's going to form a very crucial part in people being able to take out loans. But can you take us through that, Arjun?
Yeah, so firstly, rental yield, rent per week times 52 divided by the purchase price expressed as a percentage, right?
So we want higher.
I mean, not always. It depends on the person's scenario here, right? So firstly, what I find is actually when you're looking at an investing view on yield, we'll talk about that, and we'll then talk about yield from a renter's point of view, right? So from a renter's point of view, as a rent investor, if you're looking at yield, the lower it is, the better. Because when it's a lower rental yield, it means that you're getting a lot more house or a lot of house for that rental yield. For example, if you start going into more premium markets across the country, the yield really drops off and the relationship separates, meaning the mortgage payments are just going to be much higher for that equivalent home in comparison to the rent you pay. So funnily enough, when you think people get a lot more money in life when they grow in careers or businesses, some, yes, have emotional factors of the family that are dear to them, and then a home makes sense, and it's not a monetary decision. But for those who play the more monetary card and have a little bit more of an adventurous place of where they want to live, they end up recognizing the numbers for renting are just far cheaper than having a mortgage in more premium markets. And so that number gets better and better, meaning as time goes on, as strength goes on, you can actually have a better place with less cost in comparison to someone buying it. So that's the renter side. But going over to the rent vesting, and now you're turning onto the investor side, I actually am a fan of more what I call rental market pressure than rental yield. So I'll give you an example using markets across the country. Let's just say there are 100 sub-regions, and we'll call them council areas for now, that are deemed as investable in your budget. Now, as soon as you make the rental yield, say, 5%, that rental yield maybe only gives you 20 markets. But then if you make it 4%, it may give you 40 markets. So the first option of not dialing the yield too high is you open up more choices across the country to make the best decision. Now, if I ask two people, hey, you've got 20 markets to make the best investing decision, and you've got 40, and you both have the same formulas of how to read markets and actually choose the highest performing ones, who's likely to perform better? The person with more choice. Right? Because you've got 40 to choose from, you have the same methodology, you're going to have more choices. But funnily enough, percentages sound scary. Wow, that's 5%, that's 4, I want 5. But when you break down the percent of 1% on an overall investment property, you might be talking between $30 and $70 a week. And then I start asking you, so you wanted half the market choices with less chance to nail the best growing one for price growth and rent for $70 a week.
So you might be cutting off your nose to spite your face with that. You've you've gone all in on the yield, but you might be in a slower capital growth area. You might forego huge equity growth for $30, $40 a week.
Exactly. And it's not to say that the lower the yield, it grows better. We've found the relationship is you can find both, but at least know the options. By having the choice of I'm willing to dial down $70 per week. And so this is as a result, the questioning we have with our clients is very different. Instead of what yield do you want, treating it as I'm here to tick your box of preferences and then not let you know what you don't know. We say, what's the worst you can handle? Because then if I go, what's the worst you can handle? And I know where you're trying to head, as Manzrul said, on a long-term goal and reverse engineer the short-term, we can get to a point where we go, well, this horizon now opens up to this. And based on your long-term, breaking it down to the short-term, I think these markets may do better. And so now you look at it from this way, let's move on to the next part, which is yield, opening up all these cities, making the best data-driven decision for that $70 a week trade-off, which is before tax. What happens after tax? It might only be 40 or 50 now. Now let's look at the actual part, which is rental pressure. We've tracked cities where the starting yield was here and the starting yield of another location, again, lower. So again, talking the 4 and 5%, but they've crossed paths in 3 to 5 years of ownership. And this is because if you tracked pressure, which can be driven down into a few metrics, rental days on market tracking, low and decreasing. Rental vacancy, low and decreasing. Last 10 to 15 year rental growth, again, low, and now change in vacancy and change on days on market, reverting back and increasing. And these three statistics together can lead us to analyze a market with, say, 4% yield and see another one versus at 5%. And we can say, you know what, give it 3 to 5 years, this will be here. Because remember, in 3 to 5 years, you didn't pay purchase price then. You paid the purchase price from 3 to 5 years ago, which is why you might talk to many Sydney-sider investors who've owned properties over a decade. And then you're surprised to hear that some of them are positive cash flow today.
Yes.
And you go, how the hell is this happening? This is Sydney. It's the biggest city. All the rents are so expensive, or the prices are expensive, because they're forgetting a part of the equation, which is yield on purchase, right? So if your yield was, say, at a 500K place, $400 per week, and over the next 3 years it rises to $500 per week, the $100 increase, your yield on purchase is now 5.2%. And at the start, that place that might have been 4.75 or 5% now hasn't grown to 5.2, but yours has. So I think when you're looking at yield, if we take a step back, let's look at 3 decision points. As a renter, you want your yield to be lower so you get the best property in the best areas as a rent investor, because now you're paying less rent in comparison to the mortgage rent investor. Second part of the rent investor equation is where you invest. You want the yield to look at what you can handle, not versus what you want. And then look at all the markets within that to make the best data-driven decision. And then the third part is, once you've made the best data-driven decision for growth, make the best data-driven decision for rental pressure. Because then on yield on actual purchase price, you're going to come back to even a few years, and she's going to tell you can borrow a lot more than you could today. And so that's my 3-part equation to the rent vesting lifestyle and making sure it works on all fronts.
And that's just giving yourself the optionality, and it's using those data points to project where you might be in 5-10 years, which makes a lot of sense. Now, Eva, in terms of the borrowing side of things, the yield, the numbers today, they do matter in terms of what you can borrow. How does this factor into borrowing capacity, and how can brokers help people on this journey?
Yeah, so rent vesting versus buying your own home makes a huge difference into what you can do in the future. So if you buy your own home, have a mortgage, pay interest on it, can't tax deduct it. So it's money gone, right? If you rent, so as Arjun said, as little as you can, the cheapest rent you can, and obviously as cheap as your ego can take, but invest everything else you have. Whatever you invest in, the loan on that investment property becomes tax deductible. So that will boost your borrowing capacity, not only for the first property. So if you're looking at someone that has no property at all, no loans at all, and they want to borrow, I don't know, $500,000, whether it's for an owner-occupier property or an investment, it would be very different, the answer. Also depending on the bank, but you can do a lot more if you invest. So the best option for somebody that would want to build a portfolio or really start and boost their capacity is to rent, or better yet, live at mom and dad for free for quite some time and just start there. Why not? And so once you do have the first property, tax deducted, hopefully some equity there to go for the first one. But as soon as people get into their home with a big mortgage, most of the time that just kills the capacity because it's non-tax deductible. So reinvesting is really the way to start and keep going.
It's amazing just in the last 30 or so minutes, I haven't been watching the time, that we've been doing this webcast, just all of the professions that you all bring to the table are intersecting so well, which is one thing that we always repeat on the SPI show, which is to surround yourself with experts, with people that can help you on this journey. The knowledge of the data and the future projection that you'll bring to the table, Arjun, and the expertise with the mortgages and directing people to the right financial instruments, and of course the tax side, because now we're talking tax again. One common mistake that I've seen with a lot of people in the world of investing is actually choosing the wrong accountant that's not really hand-holding them and doing a good job with their finances. Munzerul, what advice would you give to our listeners on how to pick the right accountant that can support people on their property investing journey?
Yeah, so I suppose, Liam, is that as an investor, you need to relate to the accountant with your investment journey. Where do you wish to see with your investment journey, right? So say if an investor comes in who sort of says that I want to buy shares and manage funds and crypto and all the rest, then you need to find an accountant who specializes on shares and the managed funds and the crypto, right? And if an investor comes in and says that, well, I want to go a lot deeper in terms of the property investment side of it, and I see myself as being sophisticated investor over a period of time, and that's my goals and objectives, the question is your accountant on the same path within that journey? You ask the question that, do I need a compliance accountant or do I need a strategic accountant, right? There are many, many accountants who does very well of managing day-to-day tax and affairs, and that's fundamental. It needs to be done. Absolutely, right? There is nothing against, I suppose, that group of the accountants, so to speak, right? Because you got to manage the risk. You got to keep AT out of the, I suppose, the door, right? So you got to manage that. But the question is that all I want? If I only want in terms of the compliance side of it, we do that. But do I want in terms of the strategic side of it? We as an accountant, we can't give financial planning advice. I can't say that you buy in Melbourne, you buy in here, you buy in there. I can't do this. I don't have that qualification. What I can do is that I can share my experience, is to say, over the last 25 years, I've done this, I've done this, I've done this. These are some of the errors that are made. Learn from those errors, right? And these are some of the things which I thought was ordinary decision. I look back now and they were extraordinary decision. Was I fortunate? There was a science behind it, why it worked out. So rather than going through that whole sort of your learning process, utilize that experience. So in my mind, the right accountant is a combination of number of things, whether it's compliance, whether it's a strategic. Number two, whether the experience is there. And number three, can you speak to the accountant? Is the communication there, right? Is it that old accountant with the big glass or someone who speaks the language?
Can you give us some insights? And I know you quickly rattled it off a little bit earlier, but some of those areas that people should be very cognizant of things, of costs that can be tax deductible and bring that net rental income down.
Yeah, no, absolutely. Absolutely. So there's two types of those expenses, right? One is the acquisition side of it, which Eva was raising. So when an investor buys a $600,000 property, right, so you're sort of having all this extra expense, that initial level of the stamp duties and the solicitor's expense, these are part of your cost base. So you can't claim them upfront, but what you can do is that you can claim them over a period of time when you are selling it as part of the capital gain tax. So it goes against your future tax as such. All this expense, still claimable. Then you've got a number of other expenses, such as you might have done a building report. You might have done a pest report, right? You might have done a strata report. You might have paid some loan application fee. All of those expenses, we call them as borrowing expense. And borrowing expenses are the ones that you can claim it over 5 years or the term of the loan, whatever is the lesser. So it's always over 5 years. And this is a common thing at times the accountants miss, that add away those borrowing expense. The number three, we go in terms of the settlement of that property, is that when you do that settlement of the property, there's a whole bunch of settlement adjustments. So say as an example is that I'm buying it from someone else who's already prepaid the council rate up until June. As such, then when I'm buying this property in March, is that I get a credit. as a credit as a seller, from a buyer's perspective, buyer needs to pay that, right? So you don't almost see that very often because it comes in as part of your final settlement figure. So with the right accountant, what they do is to say, give us a copy of the settlement statement so we can extract all of those little expenses that you paid and we claim them upfront in addition to the borrowing cost. Then we go into our day-to-day deductions, yeah? So typical property, what do we have? So you'd be paying council rate, yeah? So a right accountant sort of asked the question that I've seen 3 lots of council rate, not 4. Have you paid the 4th? Where is the 4th one, right? So you've got the insurance. Is it a 12 monthly? Is it a yearly? Is it a quarterly? But there's got to be an insurance, right? And is it an insurance that you paid as a landlord? Is it a builder insurance? All of those claimable. Your water rates, as an example, claimable. You've done some repairs and maintenance on your own. Those are claimable as well. Travel expenses are not claimable anymore. So property inspection used to be. They've taken that away a few years ago now.
Rats.
So unfortunately, that's sort of not in there. But I think you know what's the biggest deduction comes in? The biggest deduction comes in. One is depreciation, absolutely. And number 2 is the interest. Yeah. So maybe if we speak about the depreciation, right, is that the depreciation is that once you buy this property, you can get a building depreciation, or you can get a plant and equipment, depending on when the property was being purchased. Building is your infrastructure, and you get 2.5%. And plants and equipments are carpets and tiles and blinds and so, right? In an ideal world is that a quantity surveyor needs to do a detailed quantity survey report, and as an accountant, we claim this. So it is a very well missed deduction. So yeah, absolutely.
Is this for new builds or all properties?
Both properties, right? The new build, you're more sort of the both you get. The older properties, it's more plant and equipment. You don't get the capital deduction, so to speak, in terms of the building infrastructure. You still do. But the beauty of many of the quantity surveyors, what they do is that they give you an estimate well in advance. And the estimate sort of says in the first year, we're estimating that would be a deduction. And this is our cost. And if we compare the cost, which is a one-off, compared to over the lifespan that you can claim, with that one report, strongly recommended that absolutely yes. Interest side of it is that the typical thing where the investors at time misses is that, let's say as an investor, as an example, that they have their principal place of residence, and let's assume that we borrowed 25% against the principal place of residence with the deposit as well as the incidental cost, and we're buying that 600,000 investments, right? That 600,000 investment, Eva says, okay, we're taking 80% as mortgage, so your loan is for 80, right? So you really have a $480,000 loan in there. But it's not 480 which is deductible. It is definitely 480 is deductible, but we can also claim that 25% even with the fact that you've drawn it down against the principal place of residence. So it's not so much the form of the deduction, it's the underlying nature of the deduction. And the underlying purpose of that 25% was to draw it down against the principal place of residence to utilize against the investment property to claim it. So a right accountant would always ask the question, I know you've given us $480,000 as a tax deduction, and that's the interest that you've given, but you purchased that for $600,000. What have you done with the 25%? Did you actually pay cash, or did you borrow money from your investment side of it? And if you borrowed, it will be deductible. Then one can go a little bit more deeper in terms of whether it came in from the offset account or redraw. We set that aside, right? So the big expense from an investor is absolutely the interest. That is the big expense. And ATO is most interested in terms of calculation of that interest, whether you've done it in the right way. So it needs to be. Depreciation is a big expense, and all the rest of the running cost.
And that is why you partner with the experts like yourself, Munzerul, because that was incredibly thorough. But there are a lot of areas where if you're not partnering with an accountant in the world of property who specialises in property or knows it in and out and has gone on their own journey, there's a lot of money that you could be missing out on, and a good investment can become perhaps far less profitable unless you're utilising this in the correct way. And I would like to use this as an opportunity to go on a little bit of a repivot to scaling, because the data's quite clear. There's a lot of 80-90% of investors in Australia are on their 1-2 property and can't get past that. And even speaking to my own investing journey, there's always those times where you look back and you're like, thank goodness I never did this. Thank goodness I never did that. This is probably 5 years ago or so, where my wife and I went to a really blue chip suburb. We found a place that ticked the yield boxes, it ticked expected capital growth boxes. Well, let's do it. But that one property, looking back on it, would have been such a financial burden in terms of how negatively geared it would have been. It would have stopped. It would have stopped any future growth beyond that point, which is a major consideration that people need to have when they're scaling. And Arjun, this is the question I'd like to ask you is, in that example, we looked at this property, we looked at this suburb because it was very blue chip, and it would have probably done fantastic capital growth, but it would have also been a real ball and chain on day-to-day finances. A lot of reasons that people do that and they go to those blue chip suburbs is they might have a bit of a hesitancy to looking further afield. And this is something that you spoke to earlier, which is, you need to give yourself the options, because if you give yourself the options, you can use the data to project, hey, this might not be the number one suburb, but the number two suburb we actually project will overtake number one. That might be oversimplifying it. But giving yourself the optionality of new areas to buy in, to invest in. What would you say to new investors that are listening that might still have that hesitancy to say, well, I wouldn't buy in that area, or I wouldn't buy in that city for whatever reason? How would you assuage those fears? How would you ameliorate those concerns of people who say, I wouldn't buy in that certain area, even if the data says I should?
Yeah, so firstly, I want to touch on a couple of areas because there's a few really interesting points we spoke about here on the rent vesting and also the accountancy relationship. But before I go to that, I'll answer that one first that you raised. When it comes to that blue chip decision, people look at what they're trying to chase versus what they're wrong for. What you're trying to chase is safety. What you're trying to chase is familiarity. And then what you're trying to chase off the back of that is comfort, right? And so when you look at these three things, these three words aren't investing terms.
I think it's probably the best three ways of putting it, because you're looking in areas, and not all the time, but more often than not, an area that you might know, or an area that you grew up in, or my friends are there, I know this street, so therefore you get that comfort, that familiarity, Yeah, and
so the two things that changed my mind, one is a bit lucky to be born in New Zealand, and sorry to all the Aussies out there, but us Kiwis have this one advantage. Everything's small in New Zealand except for one or two cities, right? And so we don't really say regional capital. We just say the city you're from. Like, do you know what I mean? If you live in Palmerston North, you're from Palmerston North. If you live in Hamilton, you're from Hamilton. Like, very different populations. If you're from Auckland, you're in Auckland. Like, it's just the city. So we don't have this whole thing of which city does what or where the money's at or where's this at. It's like, hey, all city has property, right? All city has people living in it, and all city has people renting in it. And it's now just about which city has less of each other to create an imbalance where it grows. But the second thing is a stat that shocked me. Over 85% of local government areas in Australia over the last 25 years have achieved more than 5% compounding annual growth rates. So it means two things. One is that city you're thinking that doesn't do something isn't as bad as you thought. And second, the city that you think has everything isn't as good as you thought. And so when you realize that the long term, most markets achieve the number that you want to be hitting in a portfolio, then you're like, okay, you can take a bit of weight off your shoulders on making a long-term mistake, because I think you're going to be okay. And now you change the decision to short-term drivers of capital growth rates and where you think opportunities are. And if you can't quantify that on that blue chip driver, because right in front of you, you're like, wait, hold on a minute. It's got not a lot of growth factors going right now. It's got rental yields that are quite low right now. My position and income of today can't afford it right now. Then are you doing something in the hope that 25 years of history changes? Right? Like that's the odds are stacked against you. And so from my perspective, it's like, okay, even if you bring up a funny example, like say Darwin, I don't know very many people from Darwin, but what I do know is that over the last 25 years, its average of long-term growth rates above 5%. But people only have so much data available to them. People can look at data in different ways and create different narratives. And so as a result, if someone just goes, I only have 10-year availability, I use that as my long-term, and the narrative is that blue chip markets perform better, they're going to bring up Darwin's charts and go, shame on you investors, horrible mistake going here, poor 10-year growth, poor results. If I just give them a 25-year chart, it's about 5.2% per annum, which isn't far off from Sydney. So little old Darwin was similar to Sydney 25-year averages, because people have that memory forgotten that between 2000 and 2005, it did upwards of 120% in capital growth rate. Same thing with towns like Bundaberg or Townsville or areas like Adelaide and Brisbane, which outperformed all our major capitals between 2000 and 2012. and then again between 2020 and 2024. So you pick your moments and you create biases, right? My thinking here is don't pick moments, pick long-term trends, and you realize that nothing's that special and nothing's that bad. And so now if you make that decision, take a short breath, put yourself out with people around you who can help you make the best short-term decision in line with a long-term strategy, and then you can start executing. So that's my part to say on that area. But coming back to the rent vesting thing, have a bit of fun on this one. My wife and I did an experiment because there was one pain point that kept coming up a lot, right? It wasn't the major family decisions of where you want to live. It was the inconveniences of constantly moving, the inconveniences of, the emotion part that comes with the inconvenience of not knowing where you may be next and not getting that next place, the rush around it. Stressful. I get it. Like I have a kid now and another kid soon. So we're a young family, and I reckon on the young side, because they probably can't walk yet and they need a carrying while you're lifting a bag or lifting this, it's probably tougher. But check this out. The math in Sydney is ridiculously in your favor. Removalist, a staycation at the Crown, a good little buffet and lunch as well covered at the Crown, packing and unpacking, and then cleaning. You put them all together, divide them by 52 as a math. Costs hit you at the time, but you make it a year-long decision. It's not the same. And then comparison to mortgages. Your family could have the house packed, put where you need it to be, cleaned, removalist, unpack, have a staycation for a night with your wife and children, or 2 nights if you need that time to let them pack and unpack and do everything. And you just appear in your new home with the things in the places that you wanted them to be. And it's still cheaper than the mortgage. But it's just that it seems so unattainable, or it seems that this is a fancy life for certain people, that people don't break down the math until you actually break it down and you realize that you can actually have that. So you turn life into a bit of an adventure. Like very few people can say, who've done the hard yards and worked their life over many decades, that they lived in the eastern suburbs, that they lived in the inner west of Sydney, they lived on the North Shore. But in our 20s, we're able to say, we did all of that stuff. We lived across these suburbs here and suburbs here, because life's an adventure, right? When you're young, and many people with maturity will look back and go, I want that. So why not grasp that and have that fun and be like, hey, I can live here and live there, and it's still not comparable to the mortgage cost that I would have going 40 Ks out. And so I think that's just one thing I want to share with people, that there is a common error that comes up that they make, that they think that these are big issues, but you can turn it into a bit of fun, a bit of adventure. And it is a bit of fun from there. And the last part I wanted to share was coming to Munzrul's point of the relationship and the accounting. Fortunately, us three sit up here and we can talk about a common goal, which is building wealth. Unfortunately, many professionals with the 3 divisions that we have don't talk about a goal of a client. They talk about the KPI of what they're known for, meaning the KPI to save tax, to save interest, to have growth. These 3 things, if you're treating them independently, you don't achieve a customer's goal, because one person's forcing you to go this way, I'm pulling your hand to go this way, and then she's saying, don't go to that bank, go to this bank to save more. It's when you're building a team, you have to have a common goal for the client and then specialize in your swim lanes, not have a KPI that's known for the industry and attack that. I get more growth. Go make this crazy decision. I will save more interest, because even though there's so many things that the finance person can do for you, many people unfortunately have the KPI is save interest, save tax, get growth. And people who work to KPIs without customer goal in mind, that's when you will struggle with the right team. Even if you do all the right things as you're hearing today, build a team around you, tick the boxes. You can tick boxes, but you didn't tick the right ones. So that's just a couple of thoughts I'd share on that answer, but also a few previous points.
I know, and those are the perfectly good ideas. And on the rent vesting front, we've done the maths on the SPI show so many times of, you touch on the opportunity to live in the eastern suburbs or live in nicer areas, which you can do because the yield relative to buying out the suburbs is better for you. And we've broken down the maths dozens of times, where it's a case of, if you look at some of the suburbs in the inner city where you've got like a really small, let's be honest, a very small terrace for $3 million. And the alternatives, you get 5-6 places out of metro. How does the math stack up? Well, yeah, you're better off renting that place in the inner city than buying it. And not just for now, but for your long-term capital growth as well. Eva, amidst all of this, there are competing priorities, in particular which debts do you pay off first, and in light of non-secured debt as well, which is something that brokers often advise their clients on and help them on that journey. Can you give us some insights into this?
Yeah, there's a lot of debts people, I guess, get without thinking it would affect them so much. So obviously the credit card and the car loan.
The jet skis, yeah, the motorbikes.
The solar panels and all that.
Yeah.
Well, if you're first-time investors, we wouldn't really have that. But a credit card, and I hear that all the time, but I pay it off every month. It doesn't matter. It's still a credit limit that you can go and spend tomorrow. That is looked at by the bank, and it's roughly 3% of that limit per month that is applied. So that's a huge killer when it's already tight. The car loan or car lease or novated lease, that's that will hurt, right?
So are you telling people to get rid of their car?
Not necessarily. It could work with it, but if your servicing is tight and you come to a broker and be like, look, your servicing capacity is only for, 300,000, you're not going to get maybe much with that. So you might want to rethink how you spend your money. If it's an asset or a liability, to have this nice car or this credit card and spend whatever on it. Or you might reduce the limit of that credit card, sell the car by a second hand, whatever it might be. So those two are the big killer. A lot of people also don't realize Afterpay, all those online.
They all get factored in.
Yeah.
So, I mean, okay.
Your behaviour of how you spend your money.
So I didn't know about the Afterpay thing. So, I mean, I don't have Afterpay, so I've never really had to upload.
Yeah,
Do you have to
ZipPay.
upload Afterpay documents or?
Not so much, but it does say a lot about your behaviour.
Oh, so because presumably it'd be on your bank.
Yeah, so you need to provide your bank statement to see how much you spend per month. So if we see, Afterpay every 3 days, well, clearly you do have
There's something going on
some
there.
problem, maybe, of shopping anywhere, and maybe you don't have that much disposable income as you are declaring or you think you are. And most people don't realize how much they spend on Afterpay because obviously it's not cash you get out of your wallet, right? So those things are huge. So credit card, car loan, ZipPay, Afterpay, also the HEX debt. And that's a hard one because it's not, you either have to pay it in full or nothing because it's a percentage of your income that is applied to a borrowing capacity. So even if you say, I paid it off and it's only $1,000 left over or whatever, it actually doesn't change your capacity. So that's one you really have to make sure it's worth paying or not paying.
So with that, obviously, just a few months ago, we had the announcement that HEX wouldn't factor into the borrowing capacity. Now, sorry if we're straying into politics, that doesn't necessarily seem to mathematically add up for me because given that it is a set percent of your income, by nature would have to impact your serviceability, right?
Yeah, it does.
It'd have to. You just have less money at the end of it.
Yeah, but they are thresholds. So really, if you haven't hit that threshold where you start repaying your HEX, it's no point paying it. It's not calculated in your capacity. So you really need to check, is it worth it or not? And it might be for you that, keep the HEX, that's fine, but get rid of the car loan.
Yes. Yep. Okay.
And it really depends how much you earn on that one and how much you're trying to borrow. And then if you do already have a PPOR and the debt there, that's probably the next one to hit because it's non-tax deductible and can really affect your capacity. One big thing I see as a mistake, and you might help me on that one, Monzo, is people having money aside and use that money to buy the investment property instead of paying down their unoccupied debt and accessing the equity in their home to go and buy an investment property and missing out on some deduction there. So there's a lot of
ins and outs
on how much you can play with the debts you've got to maximize how much you can borrow.
And that is why you partner with experts such as yourselves to help you on that journey. Now, team, an hour has gone by pretty fast. An hour's gone by very fast. So I'm going to invite all of our listeners to reach out to the three of you if they have any further questions or if they need assistance as they start to navigate their property journey. Of course, Arjun Paliwal, founder and CEO of InvestorKit, thank you so much for joining me today. Eva Lossance, head broker at Finny, thank you so much for your insights. And Manzarul Khan, chairman and founding partner, accounting at KHI Partners. What's the best way for people to reach out if they want to keep the conversation going? If they have any questions, Arjun, starting with yourself.
Yeah, two things. So in terms of reaching out, if you're ready to go and start looking at how we can help you scale a portfolio, investikit.com.au. But if you're just looking to learn a little bit more, go deeper into some of the concepts I've had, jump on our YouTube page. It's Investikit as well. And I've got a lot of videos there from our research team about some of the different concepts I've spoken about today.
You've got a rocking Instagram page as well. I'm always scrolling through. I'm like, I didn't know that. Yeah, it's just always learning. And Eva?
Yeah, fini.com.au. You can book an appointment directly with the broker. We're happy to check your capacity as now. We're happy to coach you into getting to that point where you can buy. So, or if it's just for a chat, happy to have it too.
Fantastic. And Manzarul?
kchairpartners.com.au. And anyone who new comes in, we always sit down with an hour of obligation-free meeting to understand where you are, where you wish to be, and what are their strategies, and you're most welcome.
Awesome. Well, thank you all so much for your time. That is all we have time for today. And for all of our viewers, thank you so much for joining us for the first SPI webcast of 2025. If you have any questions, please send them through and the team at SPI will be more than happy to answer those for you, and perhaps some follow-on engagement with our amazing speakers if you have any questions. But that is all we have time for today. And thank you so much for joining us. But until next time, bye-bye.